If you own gold right now, what I'm about to share could change everything about how you view your position. And if you don't own gold yet, you need to understand what's happening before Monday morning. Something extraordinary is unfolding in the gold market, not the kind of movement that makes headlines for a day and disappears. This is structural. This is the kind of shift that happens once in a generation, and most people won't realize what happened until it's too late. Let me paint you a picture of what's actually occurring right now, because the surface story you're hearing is missing the most critical pieces. Gold is trading near all-time highs. You've probably seen that. What you haven't seen is the machinery behind this move. The forces that are pushing this market aren't retail investors chasing momentum. They're not even the usual suspects. This is something different entirely. Central banks around the world just completed their third consecutive year of purchasing over 1,000 tons of gold. Think about that number for a moment. 1,000 tons. That's not a trend. That's a statement. That's a complete reversal of decades of policy. For years, central banks were net sellers of gold. They told us gold was a barbarous relic. They said modern monetary policy had evolved beyond the need for gold reserves. They sold their gold to buy dollars and other currencies. That era is over. In the past year alone, central banks bought over 1,037 tons of gold. They're not just buying, they're accumulating at a pace that's breaking records. And here's what makes this fascinating. They're doing it while gold is at these elevated prices. They're not waiting for a pullback. They're not trying to time the market. They're buying aggressively right now. Why would sophisticated institutions with unlimited resources and access to the best analysis in the world be buying gold at near-record prices? What do they see that the average investor doesn't? Let me take you inside the mechanics of what's happening, because this goes deeper than most people realize. The Federal Reserve just signaled a shift in monetary policy. Inflation data came in softer than expected, and suddenly the market is pricing in interest rate cuts. Not just one cut, multiple cuts over the coming months. Gold and silver both surged to near-record highs on this news. But here's where it gets interesting. The relationship between interest rates and gold isn't what most people think it is. Yes, lower rates typically support gold prices because the opportunity cost of holding a non-yielding asset decreases, but that's the surface explanation. The real story is about what lower rates signal about the broader economic picture. When central banks cut rates, they're admitting something. They're acknowledging that the economy needs support. They're revealing concerns about growth, about stability, about the sustainability of current debt levels, and that's when gold starts to shine. Goldman Sachs just released a forecast that should make every gold owner sit up and pay attention. They're projecting gold prices could climb 14% to $4,900 per ounce by December of next year. Their base case, not their bull case, their expected scenario. What's driving this forecast? Two primary factors: structurally high central bank demand and cyclical support from Federal Reserve rate cuts. Notice they said structurally high central bank demand. Not temporary, not cyclical, structural. That means they expect this buying to continue regardless of short-term price movements. But let's dig deeper into what's really happening with central banks, because this is where the story gets fascinating. China has been quietly accumulating gold for years, not just the People's Bank of China through official reserves. Chinese citizens, encouraged by their government, have been buying physical gold at unprecedented rates. Why? Because China understands something fundamental about the global monetary system. They see the writing on the wall. The dollar's dominance as the world's reserve currency is being challenged. Not tomorrow, not in a dramatic collapse, but gradually, systematically, through a process that's already well underway. And gold is the alternative. Gold is the asset that no government can print, no central bank can devalue, no political decision can destroy. Russia learned this lesson the hard way. When Western sanctions froze their dollar reserves, they realized that holding dollars meant holding someone else's liability, someone else's promise, someone else's political weapon. Gold can't be frozen. Gold can't be sanctioned. Gold is the ultimate neutral reserve asset. This is why we're seeing a fundamental shift in how nations think about reserves. It's not just about diversification anymore. It's about sovereignty. It's about independence. It's about having assets that can't be weaponized against you. The BRICS nations have been discussing this openly. They're exploring alternatives to the dollar for international trade. They're talking about gold-backed currencies. They're building infrastructure for bilateral trade settlements that bypass the dollar entirely. Whether these initiatives succeed or fail in their current form is almost beside the point. The fact that they're happening at all signals a massive shift in global monetary thinking. And here's what makes this moment so critical. This shift is accelerating. Look at what's happening in the physical gold market. The premium for physical gold over paper gold has been widening. What does that mean? It means people want the real thing. They want metal they can hold. They don't trust the paper promises anymore. The COMEX, the major futures exchange where gold is traded, has been seeing unusual patterns. Delivery requests have been increasing. Normally, futures contracts are settled in cash. Traders close their positions before delivery. But increasingly, traders are standing for delivery. They want the physical metal. This creates a problem, because the paper gold market is massive compared to the physical market. There are far more claims on gold than there is actual gold available for delivery. As long as everyone's content to trade paper, the system works. But when people start demanding physical delivery, the mechanics get interesting. Think of it like a bank run. As long as everyone believes they can get their money when they want it, the fractional reserve system functions smoothly. But when people start demanding their deposits simultaneously, the system reveals its fragility. We're starting to see early signs of this dynamic in the gold market. The London Bullion Market Association, the other major center for gold trading, has been dealing with similar pressures. Physical gold is being withdrawn from vaults at rates that suggest something more than normal market activity. Large holders are taking possession of their metal. Why does this matter to you? Because it suggests that the smart money, the institutional players, the people with the resources to understand what's really happening, are positioning themselves for something significant. Now let me address something important. If you're sitting on substantial retirement savings, if you have $100,000 or more in traditional retirement accounts, you need to understand how gold IRAs work. I've put together a comprehensive guide that explains how you can get physical gold into your retirement account without triggering tax penalties. It's in the description below. It covers the mechanics, the rules, the strategies that high net worth individuals use to protect their retirement wealth with precious metals. Worth checking out if that's relevant to your situation. But let's get back to what's happening in the market right now, because the timing of all this is crucial. We're entering a period where multiple forces are converging. Geopolitical tensions are elevated. The Middle East remains unstable. Ukraine continues to be a flashpoint. Taiwan is an ongoing concern. These aren't just news stories. They're factors that drive institutional behavior. When uncertainty rises, gold becomes more attractive. But it's not just geopolitics. The fundamental economics are shifting too. Government debt levels across developed nations are at historic highs. The United States alone has debt exceeding $34 trillion. That number is so large it's almost meaningless to most people. But here's what it means practically. That debt has to be serviced. Interest payments on that debt are becoming one of the largest line items in the federal budget. How do governments deal with unsustainable debt? Historically, there are only a few options. You can grow your way out of it, but that requires sustained high growth rates that seem unlikely given current demographics and productivity trends. You can default, but that's politically and economically catastrophic. Or you can inflate your way out of it. You can devalue the currency so that the debt becomes easier to service in nominal terms. That last option is the path of least resistance. It's the path that's been chosen repeatedly throughout history, and it's the path that destroys the purchasing power of currency-denominated assets while preserving the value of hard assets like gold. The Federal Reserve's balance sheet expanded dramatically during the financial crisis and again during the pandemic. They printed trillions of dollars. Much of that money is still in the system. The inflation we saw recently wasn't a surprise to anyone paying attention. It was the inevitable consequence of monetary expansion. Now the Fed is trying to manage this situation. They raised rates aggressively to combat inflation, but they can't keep rates high indefinitely because of the debt burden. High rates make that debt more expensive to service. So they're caught in a trap. They need to lower rates to ease the debt burden, but lowering rates risks reigniting inflation. This is the environment where gold thrives. Not because gold goes up. Gold doesn't go up or down. Gold is the constant. It's the measuring stick. What changes is the value of the currencies gold is priced in. When currencies are being debased, when monetary policy is trapped between impossible choices, gold maintains its purchasing power. Let me give you a historical perspective that might clarify this. In 1971, President Nixon closed the gold window. He ended the convertibility of dollars into gold. This was a watershed moment in monetary history. It meant that for the first time, the entire global monetary system was based purely on fiat currency, money backed by nothing but government promises. What happened to gold after that? In 1971, gold was $35 per ounce. By 1980, it had reached over $800 per ounce. That's not because gold became more valuable, it's because the dollar became less valuable. The purchasing power of the dollar was being eroded by inflation, and gold reflected that reality. We saw a similar dynamic in 2008 during the financial crisis. Gold was around $800 per ounce when the crisis hit. By 2011, it had reached over $1,900. Again, this wasn't gold going up. This was gold reflecting the massive monetary expansion that central banks undertook to combat the crisis. Now look at where we are today. Gold is trading near all-time highs in nominal terms. But in real terms, adjusted for inflation, we're not at the peaks we saw in 1980 or even 2011. There's room for gold to move significantly higher, just to match its previous real highs. But here's what makes this moment different from those previous periods. In 1980, Paul Volcker raised interest rates to 20% to break the back of inflation. That was politically and economically painful. But it was possible because government debt levels were manageable. Today, with debt at current levels, raising rates to 20% would be catastrophic. It would make the debt unsustainable. The government literally cannot afford to fight inflation the way Volcker did. This means the playbook has changed. The tools that worked in the past aren't available anymore. Central banks are constrained in ways they weren't before, and that constraint is bullish for gold. Let's talk about supply and demand fundamentals, because this is another piece of the puzzle that's often overlooked. Gold mining production has been relatively flat for years. Despite higher prices, despite improved technology, despite massive investment in exploration, the industry isn't finding major new deposits at the rate it once did. The easy gold has been found. What remains is deeper, lower grade, more expensive to extract. This means that supply growth is constrained. Meanwhile, demand is accelerating. We've already discussed central bank demand. But there's also jewelry demand, particularly from India and China. There's industrial demand for electronics and other applications. And there's investment demand from individuals and institutions seeking to protect wealth. When supply is constrained and demand is growing, basic economics tells us what happens to price. But in the gold market, there's a lag. Because so much of the trading happens in paper markets, because price discovery happens through futures and derivatives rather than physical transactions, the true supply-demand dynamics can be obscured for a while. But eventually, physical reality asserts itself. We're starting to see signs that this assertion is beginning. The premiums for physical gold, the tightness in the physical market, the delivery requests on futures exchanges, these are all indicators that the paper market is starting to converge with physical reality. There's another factor that's crucial to understand, the role of the dollar in all this. The dollar index, which measures the dollar's strength against a basket of other currencies, has been volatile. When the dollar strengthens, gold typically faces headwinds because gold is priced in dollars. When the dollar weakens, gold typically benefits. But here's the nuance. Gold has been strong even when the dollar has been strong. That's unusual. It suggests that gold is responding to factors beyond just dollar movements. It suggests that gold is being bought for reasons that transcend normal currency dynamics. It's being bought as insurance, as a hedge against systemic risk, as a store of value in an uncertain world. The commercial banks, the big players who trade gold futures, have been adjusting their positions. Their net short position, which had been at extreme levels, has been decreasing. What does that mean? It means the smart money that was betting against gold is covering those bets. They're reducing their short exposure. That's a significant shift in positioning. Exchange-traded funds that hold physical gold have seen inflows after a period of outflows. Retail investors are starting to return to the gold market, but they're late. The institutional money, the central banks, the sophisticated players, they've been accumulating for years. Retail is just now waking up to what's happening. This is typical of major market moves. The smart money positions early. They accumulate when prices are lower and sentiment is negative. Then, as the move develops, as the story becomes more obvious, retail investors pile in. We're in that transition phase now. The story is becoming more obvious. More people are starting to understand what's happening. But we're still early enough that there's significant upside potential. let me address a concern that some people have. They look at gold at these levels and think they've missed the move. They think it's too late to buy. This is a mistaken thinking. It assumes that gold's move is over, that we're at the end rather than the beginning of this cycle. Look at the fundamentals we've discussed. Central bank buying at record levels, constrained supply, growing demand, monetary policy trapped between impossible choices, geopolitical tensions, debt levels that are unsustainable. These aren't factors that resolve quickly. These are structural issues that will take years to play out. Goldman Sachs isn't forecasting $4,900 gold because they think the current move is over. They're forecasting it because they see these structural factors continuing to drive prices higher, and that's just their base case. Their bull case would be significantly higher. Think about what $4,900 gold means. From current levels, that's a substantial move. But it's not unprecedented. We've seen gold make moves of that magnitude before. The difference is that this time, the fundamental backdrop is even more supportive than it was in previous cycles. There's also the question of what happens if things get worse, if geopolitical tensions escalate, if we see a financial crisis, if inflation returns with a vengeance, if the dollar's reserve status is seriously challenged. In any of those scenarios, gold's role as a safe haven becomes even more critical. The price could move far beyond even the bullish forecasts. This is why gold is insurance. You don't buy insurance hoping you'll need it. You buy it hoping you won't. But if you do need it, you're grateful you have it. Gold functions the same way in a portfolio. It's there to protect you when other assets are struggling. It's there to preserve purchasing power when currencies are being debased. It's there to provide liquidity when other markets are frozen. The wealthy understand this instinctively. They've always held gold as part of their asset allocation, not because they're gold bugs, not because they're predicting doom, but because they understand that diversification includes hard assets. They understand that paper assets, no matter how sophisticated, are ultimately claims on someone else's promise. Gold is no one's liability. It's an asset in its own right. Now, let's talk about timing, because that's what this comes down to. Why is Monday significant? What's happening that makes this moment critical? Markets are dynamic. They respond to new information constantly. The convergence of factors we've discussed, the central bank buying, the Fed's policy shift, the supply-demand dynamics, the geopolitical tensions, these are all in motion right now. They're not theoretical future events. They're happening. The gold market, despite its size, can move quickly when sentiment shifts. We've seen this before. Gold can be quiet for months, consolidating, building energy. Then, when a catalyst emerges, it can move dramatically in a short period. We may be at one of those inflection points. The technical picture supports this view. Gold has been consolidating near its highs, building a base. This is classic accumulation behavior. Smart money is buying, but they're doing it carefully, not pushing the price up aggressively. They're letting sellers come to them. They're building positions for the next leg higher. When that next leg begins, when gold breaks out to new highs convincingly, that's when momentum players will enter. That's when the move can accelerate. And if you're not positioned before that happens, you'll be buying at higher prices, chasing the move rather than anticipating it. This is not about trying to time the exact bottom or the exact top. That's impossible and unnecessary. This is about recognizing when the fundamental backdrop is supportive, when the risk-reward is favorable, when the smart money is positioned, and aligning yourself with those forces. The alternative is to wait, to watch, to see what happens. But understand what you're risking by waiting. You're risking that the move happens without you. You're risking that by the time it's obvious to everyone, the easy gains have already been made. You're risking that you'll buy at higher prices out of fear of missing out rather than buying now based on sound analysis. Gold ownership isn't about getting rich quick. It's about preserving wealth over time. It's about having an anchor in your portfolio that isn't correlated with stocks or bonds. It's about insurance against monetary instability. It's about participating in a market that's being driven by some of the most powerful forces in global finance. The central banks buying over 1,000 tons per year aren't speculating. They're not trying to make a quick profit. They're making strategic decisions about how to protect their nation's wealth. They're responding to fundamental changes in the global monetary system. They're positioning for a world where the dollar's dominance is less certain, where gold's role as a neutral reserve asset becomes more important. You have the same opportunity they do. You can make the same strategic decision. You can position yourself for the same fundamental changes. The difference is that you need to act while the opportunity is still available at reasonable prices. Think about what's at stake. If gold moves to $4,900 as Goldman Sachs forecasts, that's significant appreciation from current levels. If it moves beyond that in a more bullish scenario, the gains could be substantial. But even if it doesn't move at all, even if it just maintains its current value, you've preserved your purchasing power in an environment where currencies are being debased. That's the asymmetric nature of gold ownership right now. The downside is limited. Gold has thousands of years of history as a store of value. It's not going to zero. It's not going to lose its fundamental appeal. The upside, however, is substantial. If even half of what we've discussed plays out, if central banks continue buying, if monetary policy remains accommodative, if geopolitical tensions persist, gold has significant room to move higher. This is the opportunity that's in front of you right now. Not someday, not when things become clearer. Now. Because by the time things are clear to everyone, by the time the mainstream media is talking about it constantly, by the time your neighbors are buying gold, the easy money will have been made. The smart money is positioning now. The central banks are buying now. The institutional players are accumulating now. The question is whether you'll join them or whether you'll wait and watch and wish you had acted when you had the chance. Monday isn't just another day. It's the beginning of a new week in a market that's poised for significant movement. It's another opportunity to make a decision that could impact your financial future. It's another chance to position yourself intelligently for what's coming. Don't be caught off guard. Don't be the person who looks back 6 months or a year from now and realizes they understood what was happening but didn't act. Don't let analysis paralysis prevent you from making a sound strategic decision. The information is in front of you. The fundamentals are clear. The smart money is positioned. The only question is what you're going to do about it. Are you going to take action? Or are you going to wait and hope for a better opportunity that may never come? Gold doesn't care about your timeline. It doesn't care whether you're ready. The market moves based on supply and demand, based on institutional flows, based on fundamental forces that are much larger than any individual investor. Your job is to recognize when those forces are aligned, when the opportunity is favorable, and to act accordingly. This is that moment. This is when the pieces are in place. This is when the smart money is positioned and the fundamentals are supportive and the technical picture is constructive. This is when you make the decision that your future self will thank you for. Monday morning, the market opens. Gold will trade. Central banks will continue buying. The fundamental forces we've discussed will continue to play out. The only variable is whether you'll be positioned to benefit from what's coming or whether you'll be watching from the sidelines, wishing you had acted when you had the chance. The choice is yours. The information is available. The opportunity is here. What you do with it will determine whether you're prepared for what's ahead or caught off guard when the next phase of this move begins. Don't let this moment pass. Don't be the person who understood but didn't act. Be the person who recognized the opportunity and positioned themselves intelligently for what's coming. Your financial future may depend on the decision you make right now,